In the past week, we have probably seen the news that have driven the price of Bitcoin to its all-time high once again.
To infinity and beyond!
So what drove Bitcoin to its all-time high once again could have been the Bitcoin ETF that was released just a couple of days ago. So what is this Bitcoin ETF? How does it work? And is it even worth buying into? What's up y'all, it's Jordan once again with another video. So ProShares announced their ProShares Bitcoin Strategy ETF, which is approved by the SEC and will start trading on the NASDAQ on the 19th of October. And as of recording, the ETF trading volume has crossed $1 billion. So this might sound all good, but there are some things to note about this ETF that operates differently from a traditional ETF like the S&P 500 or the STI ETF if you are in Singapore. So an ETF or an exchange-traded fund is operated by a fund manager who will collect money from investors, take the collected money and buy shares from the market. And when you purchase the S&P 500 ETF, you own a percentage of Tesla, Google, Amazon, and the top 500 companies in the US. And in the case for STI ETF, you own the top 30 performing companies in Singapore. So depending on the ETF that you are buying, you'll have different percentages of different companies as well. So essentially, when you purchase an ETF, you own the underlying asset as well. But in the case of the Bitcoin ETF, we see the mass media promoting it as the Bitcoin ETF. Which to any layman like me will start thinking, should I cash out my crypto now and own an ETF that's regulated? Because since an ETF owns the underlying asset as well, it means that I will own Bitcoin too, plus some other cryptocurrencies, which is great. But before you head over to your wallets or your exchange to start cashing out, you might want to hear more about the ETF itself. So the ProShares Bitcoin Strategy ETF trades under the ticker BITO. And BITO is not a true blue ETF in my books. What BITO is a futures ETF. It might sound a little bit confusing and stuff because it kinda is. So futures are basically an investment derivative which states the price to buy or sell a certain asset at a specific time in the future. These are commonly used for commodities like rice, oil, coffee, cocoa, etc. So let's take a step back and understand why fund managers or fund houses create ETF. So imagine if you're trying to buy the top tech firms in the world like Google, Amazon, Tesla, Microsoft. Buying one stock of each company will probably cost you a bomb because Tesla is like $900, Google is almost $3,000, Amazon is $3,500, Netflix is almost $600, and there are many more tech firms out there, but essentially you gotta be damn filthy rich to own one of each stock.
Rich? Rich what?
So this is where ETFs comes in. So imagine buying an ETF like QQQ, you'll be able to purchase the top performing companies at a fraction of a cost, and QQQ is only sitting at $300. So with about $300, you're able to purchase a little bit of the top tech firms in the world. So what an ETF does essentially is to allow investors to enter the market with a lower barrier of entry and yet still be able to get gains on the company that they like or the companies that they support. So back to the Bitcoin ETF, there are a few problems that I personally see here. So the first problem I see here is that to enter Bitcoin is not tough. There are many exchanges out there that are available for anyone to start purchasing Bitcoin. It's almost as easy as doing online shopping, and if you can order food from your phone, you can buy Bitcoin as well. It's just that simple. And you don't have to have a huge sum of money to purchase Bitcoin or to even start investing in Bitcoin. And if you're looking for an exchange, I have left links in the description down below where you can check these exchanges out. The second problem here is the cost of owning the ETF versus owning Bitcoin. I cannot say much for our friends in the US because they do have taxes based on the cryptocurrencies that they have or they own or something like that. And it's a really confusing world there. But here in Singapore, we do not have capital gain taxes, which is great because our gains in capital are not taxable.
No tax? Awesome.
But owning the ETF will incur a tax because buying a US stock do incur some taxes and fees as well. And if you're gonna say,
but it's backed by the SEC, my coins are safe.
Technically, by having the ETF, you do not own the coins, just the future contracts, which you can easily purchase on major crypto exchanges as well. And let's be real, keeping your crypto is fairly simple. It's like keeping your email safe, you don't tell anyone your passwords, activate 2FA if you can, store them in a hardware wallet which costs probably $100. You can store bitcoins there and just leave it alone. No one is gonna get to them unless you give them your seed phrase or you give them access to your wallet. On top of that, when you purchase BITO, there is an expense ratio of almost 1%, which is pretty expensive if you ask me for an ETF. And a fun fact, you will not be holding any bitcoins through this ETF. So next we have ownership, which is sort of linked to the previous few points. If you really want to own Bitcoin, I personally feel that it's much better using your money to go into the market and purchasing those Bitcoins, like the actual Bitcoins. And like really own them. Because based on the SEC documents, this ETF will not be owning any Bitcoins at all. The last problem here we have is contango.
Wango Tango!
A contango is a situation where the future prices of the underlying asset is higher than the spot price. And the problem here is not targeted mainly at the Bitcoin ETF, but the idea of having a futures-based ETF. So for example, when you purchase a futures contract to, let's say, purchase oil at $100 per barrel on 3rd January 2022. Come 3rd January 2022, if the price per barrel is $110, the investor profits $10 because he bought the barrel at $100 and he can sell it for $110. And that's the end of the futures contract. But in a futures-based ETF, after the contract expires, a new contract has to be bought, and this is where it gets really messy. So imagine if the contract is to purchase Bitcoin at $65,000 on the 3rd of January 2022. Come 3rd January 2022, Bitcoin goes to $80,000, that's great profits. But the problem now comes because the ETF will need to purchase new contracts, and now the prices of the contracts will be super high. So if you scale it back a little bit, if the prices of the contract increases every month by 1%, this can cause investors an annualized loss of almost 13%. But this number might change because the prices of Bitcoin is so volatile. There might be months with great returns and there might be months with not so great returns. On top of that, there is also interest income because futures are leveraged products. In layman terms, you will have to downpay a portion of the contract value as collateral.
What collateral?
So as an article in Bloomberg shows that if you were to put $60,000 into BITO or the Bitcoin ETF, $20,000 of it will be used to collateralize to create one synthetic Bitcoin. And the remaining 40% will be kept in cash to earn interest. And this sounds really silly to me because I would personally just purchase Bitcoin,
Silly!
do some DeFi yield farming or staking, which is so much easier, so much faster, and I own these Bitcoins. But if you're interested to read the article, I'll link it in the description down below together with all the exchanges that I use to purchase Bitcoin. So personally, I'll put a little bit of money into BITO just to try it out, but I'm not banking too much hope on it. And that's it for today's video. Don't forget to smash the like button, subscribe, and I'll see you in the next one.